Okay, let's get right into it. There's some new data coming out of the US housing market that honestly is pretty worrying. It looks like a troubling trend we've been watching isn't just continuing, it's actually picking up speed.
Right off the bat, here's the number you need to see: 21%. That's the year-over-year jump in foreclosure filings as of this November. That is a huge signal that a growing number of American homeowners are in some serious financial trouble.
And nope, this isn't just a one-month blip. According to Rob Barber, who's the CEO at the data firm ATTOM, this is the 9th straight month we've seen this kind of increase. So what we're looking at is a sustained, really persistent trend.
So let's pull back the curtain and break down what's really going on behind these headlines. What do all these different numbers and foreclosure terms actually mean for people?
First, just a super quick refresher so we're all on the same page. A foreclosure, well, it's just a legal process where a lender takes back a property because the owner has fallen too far behind on their mortgage payments. Simple as that.
Now, to give you a sense of the scale of this problem, just last month, over 35,000 U.S. properties had a foreclosure filing started against them. That is a massive number of homes and families entering this really difficult process.
And this number, this one's tough. This represents the final, most severe stage. These are the completed foreclosures, the repossessions. It's the point where people have officially lost their homes. And that figure is up a staggering 26% from just a year ago.
And if you want to know what's coming next, look at this. Foreclosures starts the very beginning of the whole process are up 17%. This tells us the pipeline of homeowners in distress is still filling up, which, is a really important leading indicator of where things are headed.
So this brings us to the most important question, right? Why is this happening? Why are so many more American homeowners suddenly finding themselves unable to make their payments? Well, it all boils down to a massive affordability squeeze. Homeowners are just getting hammered from every direction. I mean, think about it. Property taxes are going up. Home insurance costs are just skyrocketing in a lot of places. And of course, high interest rates make borrowing anything way more expensive. And all of this is hitting at the exact same time that personal savings are drying up. It's really a perfect storm of financial pressure.
Now, I know what a lot of you are probably thinking. Wait a minute, is this 2008 all over again? Well, there's a really key difference in what's driving the crisis this time. The 2008 crash was all about super risky, subprime loans given to people who couldn't afford them. Today, experts say the loans themselves are actually much safer. The problem isn't the quality of the loan, it's the fact that even qualified homeowners are getting completely overwhelmed by all these other skyrocketing costs.
And look, this isn't just a problem for those directly facing foreclosure. It creates a ripple effect that can actually impact the entire economy. That's why this matters to all of us, whether you own a home or not. And let's never forget the very real human cost here. As Rob Barber points out, behind every single one of these statistics is a family dealing with the loss of their home, profound financial instability, and just an incredible amount of emotional distress.
So how does this actually spread? Well, you can think of it like a domino effect. It starts with one homeowner under strain. Then, as more foreclosures hit a single neighborhood, they create an oversupply of bank-owned properties. This flood of new listings can actually drag down property values for everyone in the area, even for people who are paying their mortgage right on time.
And on a much bigger scale, a sustained rise in foreclosures is a major economic red flag. It tells analysts that something fundamental is off in the economy, that things like employment, wages, and interest rates are putting an unbearable strain on the average American household budget.
So, where is this crisis hitting the hardest? Let's take a look at the data and map out some of these hotspots across the country.
When you look at the state level, Delaware actually has the highest rate right now, with one foreclosure filing for roughly every 1,900 homes. Right on its heels are South Carolina, Nevada, New Jersey, and Florida.
And if we zoom in even closer to major cities, Philadelphia has the most intense rate at the moment, one filing for just over 1,500 homes. Las Vegas, Cleveland, Orlando, and Tampa are also feeling some significant pressure.
So all of this, it all leads us to the big final question. We see the numbers, we see the trend, but what does it all mean for what's coming next?
And here it is, the crucial question on everyone's mind. Are we just seeing the housing market normalizing after a few very strange years, like some analysts suggest, or are 9 straight months of rising foreclosures a much more serious warning sign, the canary in the coal mine for deeper economic trouble ahead? That's the question this data forces us all to ask.